Welcome to Chapter 2, Qualitative Characteristics of Useful Financial Information. What characterizes useful financial information? The framework answers this question by telling us all about fundamental qualitative characteristics and enhancing qualitative characteristics. Before we give a rundown of these two, we have to appreciate that if we talk about fundamental characteristics, these are information traits that are necessary for the information to be considered useful. Absent these fundamental characteristics, the information is not useful. Enhancing characteristics, on the other hand, improve the usefulness of information. Now, what are the fundamental qualitative characteristics? Just two, actually: relevance and faithful representation. I'm pretty sure we have talked about relevance in at least one other accounting subject, but for purposes of refreshing our minds, information is deemed relevant if it is capable of making a difference in your decision-making. If you are a prospective investor, for example, and you have learned that the business is restricting a significant portion of its retained earnings for the expansion of its operations abroad, will you consider this information when you make your decision? If the answer is yes, then the information is relevant. Take note that, according to the framework, information may be capable of making a difference in a decision, even if some users choose not to take advantage of it or are already aware of it from other sources. Financial information is deemed relevant if it has predictive value, confirmatory value, or both. Predictive value means the information can be used as an input to processes employed by users to predict future outcomes. Take note, it is not an actual prediction, but it can be used to make predictions. Confirmatory value, on the other hand, allows the information to provide feedback to previous evaluation. In order to simplify things, let us take a non-accounting example. Let us say that the information you received is this: the cutoff grade for the Bachelor of Science in Accountancy program is 2.0. If you are a BSA student, is this relevant information? Quite obviously, yes. Now that you know that the cutoff is 2.0, will you be able to predict future outcomes? Again, yes. For many of you, you have assessed your capabilities of this 2.0 cutoff and found that it is something you predict you can be able to meet. Now comes the end of the semester. Can you now provide feedback if your previous prediction of meeting the cutoff is correct? Definitely yes. You can say that you were right or that you were wrong. Take note that information is relevant if it has either predictive or confirmatory value, or both. Ready to leave the discussion on relevance behind? Not so fast. No discussion about relevance can ever be complete without talking about materiality. For those of you who have already taken Accounting 401, you must have remembered how your class extensively talked about materiality and how it is a matter of both nature and extent. Suffice it to say, let us remember the 2018 Conceptual Framework's definition of materiality. That is, information is material if omitting, misstating, or obscuring it could reasonably be expected to influence decisions that the primary users of general-purpose financial reports make on the basis of those reports, which provide financial information about a specific reporting entity. While in the past we simply say what is material to me may not be material to you and vice versa, the framework clarifies it by saying that we have to take the viewpoint of the primary users, that is, the potential and existing investors, lenders, and other creditors. The framework further says, materiality is an entity-specific aspect of relevance based on the nature or magnitude or both of the items to which the information relates in the context of an individual entity's financial report. In other words, it is impossible to set one uniform quantitative measurement for materiality, as it depends on the entity as well as the nature and magnitude of the item. The second fundamental characteristic is faithful representation. According to the Conceptual Framework, to be useful, financial information must not only represent relevant phenomena, but it must also faithfully represent the substance of the phenomena that it purports to represent. Substance over form. This is especially crucial when the legal form of the transaction differs from its substance. Under faithful representation, it is not enough that we provide information only about its legal form. This is one of the reasons why we account for leases the way we do now. We do not only look at the legal form, but the substance as well. Faithful representation has three ingredients: completeness, neutrality, and freedom from error. Completeness means all necessary information is included. Neutrality, on the other hand, is the absence of bias and is supported by prudence, or the exercise of caution when making decisions. The framework warns us that freedom from error does not mean accuracy in all respects. It simply means that there are no errors or omissions both in the description of the transaction and in the processes of producing the information, including the use of estimates where necessary. In applying relevance and faithful representation, one must remember that these are fundamental. The framework aptly summarizes this by saying, neither a faithful representation of an irrelevant phenomenon nor an unfaithful representation of a relevant phenomenon helps users make good decisions. Okay, we are now ready to move to the enhancing qualitative characteristics. These are comparability, verifiability, timeliness, and understandability. We have to remember that these merely enhance information that is already both relevant and faithfully represented. In other words, it improves what is already fundamentally useful. Comparability is the only qualitative characteristic that does not refer to a single item. Quite obviously, to compare, one must look at least two items. Comparability allows users to identify similarities and differences among items. It helps the users of the information to, for example, determine if the business revenues are doing better this year compared to last year. Comparability is not the same as consistency, which is the use of the same methods for the same items. According to the Conceptual Framework, comparability is the goal. Consistency helps to achieve the goal. Verifiability is something that, at this point, should be quite familiar to you. It means that different, knowledgeable, and independent observers should reach essentially similar conclusions. Verification can be either direct, where you verify by direct observation, or indirect, such as in recalculation or mathematical modeling. Timeliness simply means that the information must be made available to the users in a timely manner. Information will no longer be useful if the decision that needed it was already made even before the information is available. Lastly, we have understandability. In this qualitative characteristic, we have to keep in mind that the financial reports are prepared for users who are presumably equipped with reasonable knowledge of business and economic activities. It would truly be close to impossible to make the financial reports understandable to people who don't have a working knowledge of accounting and businesses. Enhancing qualitative characteristics should be maximized to the extent possible, but it cannot take the place of fundamental qualitative characteristics. Before we close off this chapter, our major takeaways are: fundamental characteristics are necessary for information to be useful. These include relevance and faithful representation. Information is relevant if it is either predictive value, confirmatory value, or both. And information that is relevant must also be material. Faithful representation is further characterized by completeness, neutrality, and freedom from error. Enhancing characteristics improve information that is already fundamentally useful. These characteristics are comparability, verifiability, timeliness, and understandability. Alright, when you're ready, I'll see you in Chapter 3, Financial Statements and the Reporting Entity.